Singapore's inflation may remain elevated for years to come, according to a Singapore Management University survey. It's forecasting an inflation rate of close to 5% in 2017. And the survey also found that Singaporeans expect inflation to hit 4.4% this year. Inflation averaged 4.6% last year, not quite as hot as the 5.2% in 2011, but elevated nonetheless. Inflationary expectations have subsided because of the uncertain global climate, but survey respondents predict 4.4% in 2013, near to the top of the Monetary Authority's estimated 3.5 to 4.5% range. The survey's composite 5-year expectation is 4.97%, just below the 5.2% predicted in the survey in September.
People are always concerned. They don't always see very clearly what will happen 5 years later. They have to rely on media, for example. They have to rely on how things are looking, their confidence level. So we are not going to put too much money into the fact that it's going to be 5% 5 years later. It might really come down if the conditions actually improve. So this is perceptions.
However, the recent cooling measures in the property sector are expected to put a check on headline inflation. Economists say inflationary pressure in Singapore are not just asset prices boosted by liquidity, but homegrown prices as well, such as labor and rental costs. And investors are always looking at hedging their wealth, which is being eroded by inflation.
The natural place they look at is property. If one part of the property market is closed, they will go into another. If more and more administrative measures are placed on property, then I'm sure innovative financial institutions will come up with new kinds of products that will enable Singapore savers to invest in property but bypass regulations.
Some members of the survey panel suggested the issuance of inflation-linked bonds may help Singaporeans to hedge against price rises rather than a misallocation of assets geared entirely toward real estate.